Hello everyone, my name is Blago and I'm the CEO and founder of Modeliks, a business and financial planning solution for startups and SMEs. Today, we're going to create an investor-ready, professionally done financial model for a SaaS business in about 30 minutes. Without further ado, let's jump into Modeliks. Now, this is Modeliks. In order to create a professional investor-ready financial plan for a SaaS business or for any business, you would have to go or provide assumptions for the following sections: the revenue assumptions, cost of goods sold, your employees, expenses, assets, financing, taxes, working capital. Once you have provided information about these within these sections for your financial plan, in Modeliks you will get automatically calculate the three most important financial statements for your business, and that is the profit and loss statement, the balance sheet, and the cash flow statement. And in addition, you will have automatically calculated a bunch of financial charts and a specific SaaS dashboard for if your business is a SaaS business. We'll look at this in a little bit in a bit of time once we have actually created our financial plan. So usually, when you start with creating your financial plan, you start with your revenue projections. Now, to make our job of creating a SaaS financial plan as simple as possible, here within Modeliks, we will start from a financial model template for a SaaS business. When you first log in into Modeliks will ask you what is your industry, and do you want to start with a predefined financial model template. If you said yes, then you would have already loaded the financial model template for a SaaS business. But if you haven't clicked that, then you can just click here on this scenario button up here, click add scenario, give your scenario name, and then click here, select an industry model template. And from the drop down, you select the SaaS subscription model, click create, and you will have your subscription model template or SaaS business model template loaded for you in Modeliks. Now, let's start creating our financial plan. First, we're going to start with our revenues. Usually, there are two types of revenues in a simple SaaS business or new SaaS business. You would have your subscription revenue, or this is the amount of money you generate from selling subscription plans for your service to your clients. And then second revenue type, not all SaaS businesses will have it, but some will, is an implementation service revenue. If your SaaS product is a little bit more complicated and some of your customers need a service where you implement your product for them so they can start using it, then you could have the second revenue stream, which is implementation services. So let's start with calculating our subscription revenue. We'll click edit here on the subscription revenue stream. Now, there are several predefined financial SaaS plans here, but you can add and delete plans in order to make this fit your specific business model. In this case, in this example, we will have two types of subscription plans: a standard and a premium. And for each one of them, we'll have a monthly subscription and we will have an annual subscription. That's it. Our plans are defined. We click next. Now, there are four things we need to define for our subscription revenues to be calculated correctly. Number one is the number of signups. Or these are the number of new customers that we expect to get in each period of time in the future. Number two is the churn rate, refunds, refund rate, and the subscription price. We'll go through each one of them in detail, and I will explain. I will explain them in detail as we go along. First, let's define the signups or the number of new customers that we expect to get in each period. Now, let's say that in the first we expect to get 100 customers per month for the first 6 months, and then we expect to ramp up our customer acquisition to about 200 customers per month for the next 6 months in the year. In Modeliks, always the first year is planned on a monthly basis because you always need more detail for the first year of your business, and then the following years, in this case, the additional 2 years, are planned on a annual level. So, how many signups or how many new customers do you expect in year two? Let's say 2,500, and in year three, we expect to have 3,000 new customers. Now we have defined the number of new customers that we expect from our business. You can input them like that, as I just did now, the number of new customers. You can also use this percent growth rate functionality, where you define when do you start to get new customers, what is the number of new customers in the first month, and then what is the percent growth rate in the number of new customers per month and per year in order to calculate your the number of new customers. So either way, you either input the numbers or you use a growth rate. Then you need to define this is the total number of new customers that your business gets. But now you need to define what is the percentage breakdown per subscription plan. As we said, we have four subscription plans, or standard, premium, monthly, and annual subscriptions. So what percent of these signups are going to be how are they going to be allocated? How are they going to break down per plan? So let's say that 30% of them, of the new customers, subscribe to the standard monthly plan, 30% subscribe to the premium monthly plan, 20% to the standard annual plan, and 20% to the premium annual plan. Finally, last assumption you need to provide is the number of customers that you have at start, and this is for already existing business. If you already are an existing SaaS business, you can define the number of customers that you have at the time when your plan is starting, and then your plan will continue to grow your customer base from there. But here we are creating a financial plan for a new SaaS company, so the number of customers that start, we're going to leave them at zero. With that, we have defined our signups, or the number of new customers for our business. We click next. We go to the churn rate. Now, the churn rate is the percentage of your customers that you expect to stop using your service when the time comes for them to renew their plan. Now, what that means is that we provide here the percent of people that will stop being our customers when they need to renew or pay again for their subscription. So for the monthly plans, that means a monthly churn rate. What percent of our monthly customers are going to stop using our service? Are going to stop using our service each month. So let's say that about 5% of customers stop using our service, so they churn every month. From our premium customers, let's say 4% of them stop using our service. And then on annual level, let's say that 15% of standard customers are going to churn, and then 12% of premium customers are going to churn on the annual level. With that, we have defined our churn rates. If you want to have a more detailed calculation, if you expect your churn rate to change over time, you can click on this button here, enter breakdown per month, and you will be able to enter different churn rates by month and by year. To keep this simple, let's keep the churn rates flat over time. We click next. Refunds. What percent of our signups we expect to request a refund after they have paid? This is if we are providing refunds to customers. A lot of SaaS companies, they do not provide refunds, so we will keep this at zero. But if you do provide refunds, then here the input is just what percent of your new customers are going to request a refund, and you're going to refund their money. You click next. Subscription price. What is the price that we expect to charge for each plan? So let's say that for the standard monthly plan, our subscription price is going to be $50. For the premium monthly plan, let's say we charge $80. For the standard annual plan, let's say that we charge $450. And for the premium annual plan, let's say that we charge $700. Again, if you expect your prices to change over time, you can click on the enter breakdown per month and enter different prices for each period. But again, let's keep it simple. We provide one price that we don't expect per plan, that we don't expect to change over time. And with that, we have calculated. Now we click save and close, and we have calculated our subscription revenue. Here it is. We start from 5.8 thousand in the first month. We get to about $92,000 in the last month of the first year, and going up to 2.9 million of revenue in the last year or year three of our plan. Now, let's go to the second revenue stream type, implementation services. Again, as I said, not every SaaS company is going to have this type of revenue stream, but some will do. So, how are we going to calculate the implementation services revenue? Well, this is usually for new customers. So we're going to multiply the number of signups or the number of new customers by the percent of new customers that require a implementation service. Let's say that 50% of our new customers require implementation service, and then an implementation fee for per customer. So let's say we charge customers $300 for implementation, and we copy paste that. Let's say assume that price doesn't change, and with that we have calculated our implementation services revenue and total revenues for our business. Let's move on to cost of goods sold. Now, cost of goods sold, these are the direct costs that you have in order to be able to provide your service to your clients. Now, in a SaaS business, usually there are three, in any SaaS business, there are going to be minimum of three direct costs that any SaaS business would have. That is hosting an IT infrastructure, your servers, your databases. Usually we use cloud servers, so there is a cost for that. There is your customer support team. This is a direct cost for providing your service to your clients, but I will come back to the customer support team a bit later. And the third type of direct cost would be payment processing. Usually, we charge our clients pay by credit card online for our services, and the payment processor will charge us a specific fee for processing those payments for us. So let's look at them one by one. Hosting an IT infrastructure. Usually, I would suggest that you estimate this as a percentage of your revenues, because as your customer base grows, also your IT and IT infrastructure costs will grow. So let's say that about 5% of your revenue is going to go into IT infrastructure and service cost. Customer support, we'll come back to this. Payment processing cost. Now, usually, each payment processor will charge a variable transaction fee or percentage fee of the cash that they collect for you, and a transaction fee per transaction, regardless of what is the size of the transaction. There is usually a fixed transaction fee that they will charge you. So the variable transaction fee is equal to the total cash collections that we have that we collect through for our business, multiplied by the percent of cash collections that are paid by card. And if you're a SaaS business, usually 100% of your collections are going to be collected online. So let's keep that at 100%. And then transaction fee. This is the fee that you paid from the total cash that your payment processor collects. What percent will they keep as a transaction fee? Usually this would be somewhere around, let's say, between 3 and 4%. Let's say 4%. So 4% of the cash they collect for you. We copy paste this all the way to the end. So that's the variable transaction fees. Fixed transaction fee will be equal, will be paid by transaction. So the total number of transactions that we have collected online, multiplied by the percent of those transactions that are collected online. We said all of our transactions are paid online, so 100%, multiplied by a fixed fee per transaction. So usually this is about $0.5. So $0.5, we copy paste this all the way to the end. You can see that it's 0.5 here. And that's it. Now we have calculated both the fixed and the variable payment processing fees. We go next to employees. Now, employees. Most SaaS businesses would have a customer support team, marketing team, a technical technology team, and some general and administrative personnel like your CEO and some support staff. Now, In this financial model template, there are few types of employees that we have included, but for smaller businesses, not all of them will be relevant. For bigger businesses, SaaS businesses, there will be more types of employees that you would have. So you can easily delete any of these employees that we have in the financial model template, or you can add more employees by clicking the Add Employees button, defining the name, and just following the defining the name of that employee or that employee type, and then just following the process for inputting data for this type of employee. So now let's look at our customer support team. Usually, the number of customer support employees that you need will grow as your business grows. The more customers that you have, the more customer support employees you will need. So you need to establish that relationship between the number of customers and the customer support employees that you will need. How do you do that? That whole logic is already set up in the financial model template in Modeliks. So in order to calculate the number of employees that we'll need in customer support, we will calculate it based on the number of customer support tickets that we expect to have over time, divided by the capacity of customer support tickets that one employee can handle. Yeah. So let's look at this. The number of customer support tickets that we expect will be calculated as the support tickets from existing customers and support tickets from new customers. Support tickets from existing customers will be calculated as the total number of customers that we have at the end of each period, multiplied by the percent of existing customers that actually require customer support, multiplied by the number of customer support tickets that each one of these customers will write. Not always every question is resolved with just one customer support ticket. Sometimes you answer a question and there's another question. You answer that question, there's another question. So there might be more than one customer support tickets per customer when they get in touch with our customer support team. So number of customers at the end of period, we already have this defined when we defined our revenues, our subscription revenues. What percent of these existing customers will require customer support? Let's say that 20% of our customers contact us on monthly basis with a question, and then on annual basis, let's say that about 50% of our customers contact us with a question. Now, how many support tickets do we expect from when they get in touch with us? Let's say that on average, when a customer gets in touch with us, they raise about 3 customer support tickets or 3 questions on monthly basis, and then on annual basis that will be 36 questions. Now, with that, we have defined the number of support tickets from existing customers. Now, support tickets from new customers. This will be calculated as the number of signups or the new customers that we expect, already defined when we calculate our subscription revenues, multiplied by percent of those new customers that will require customer support. And usually this is usually when customers start using our product for the first time, they will have more questions. So let's say about 60% of our customers have a question for us, for our customer support team of our new customers. How many support tickets? 3 support tickets per customer. And then with that, we have calculated the number of support tickets from new and from existing customers. So total support tickets first month 240. Now, what is the capacity that one customer support employee, how many tickets can one customer support employee handle? Let's say that this is about 800. One customer support employee can handle about 800 tickets per month. And almost 10,000 tickets per year. Now, with that, we have defined the capacity that we need for number of customer support tickets. Now, but at the beginning, as our business starts, let's assume that our customer support team will not be so well trained. They will need some time to gain confidence and knowledge into the system. So let's say that at the beginning they will be able to do one customer support employee will be able to do 300 tickets for the first 3 months. Then they will ramp up to 500 tickets per month for the next 3 months. and after that they will become, they will reach their peak performance, which is 800 tickets per month per customer support agent. And with that, now we've defined the total customer support employees that we'll need. Automatically calculate. We start with one, then it grows to two, seven, and then 10 in the last year. And now we have logically linked the number of customer support employees with our business, with our subscription revenues and the number of customers. And if we change anything in our revenue assumptions, we say, we're going to expect that we're going to grow much faster than that. Automatically, the number of customer support employees will grow because now they're both linked together. The last thing we need to provide here, the last assumption, is the employee cost for our customer support team. This is the gross salary. Let's say that we expect to pay $1,300 per month in gross salary on average for our customer support team. And with that, we have calculated our customer support cost. CMO, Chief Marketing Officer, usually employee number. This is usually one person. Let's say we're going to hire him from the beginning, and then the employee cost for that for his gross salary, we're going to edit here for our CMO. So one number of employees, CMO, it's only one. Go next. Gross salary per employee. This is the salary of the CMO. We have decided here to calculate it with a growth rate. He's gonna be hired in the first month, January 2024. That's the first month of this plan. And let's say we're gonna pay him 2,000 gross salary, and then the growth rate is gonna be 0% for the first year, and then we expect 10% growth in his salary, annual growth in his salary. Click save and close, and that's the salary of the CMO. Now, I'm not going to go into every employee type by employee type, but you now get the logic of how it works in Modeliks for you to be able to provide assumptions about all your employees. I will do just one more. Let's do a few more. Product management. Let's say we'll have one product manager in our business, one product manager, and then maybe in year two we'll need a second one. And then let's say that their salary is annual salary is $1,500 or monthly salary. Sorry. Copy paste that, and then if we expect that salary to grow, we can just either input it here. Let's say it goes up to 1,800, and then 2,000. Or if we want to use a growth rate for the salaries as we did for the CMO, we can go into edit here. This is our product management team. And then we will go to the cost per employee. Click next. And here we're going to click percent growth. This is the first salary. It doesn't grow in the first year, and then it grows by let's say 10%. 10%. And with that, we have calculated our salaries with using a growth rate. Click save and close. Okay, the last we're going to do for this example is going to be the account management team. Again, here the account management team is calculated based on the volume of business that we expect to have in our business. So the number of employees is calculated based on the number of customers that we have at the end of each period, and then the capacity of number of customers that each account manager can handle. So let's say that each account manager can handle about 200 clients at any point of time. So with just those two inputs, now we have calculated the number of account management employees that we will. There was the salary cost. Sorry, that was wrong. 200. The capacity per account manager, and now we have automatically calculated the number of account managers that we will need. The only thing we need to input now is the employee cost. Let's say that we pay them $1,500 per month. And with that, we've calculated the number of account management employees that we need and the total cost for our account managers. And so on. We go on line by employee type by employee type. We fill in our assumptions, and at the end we'll have the employee cost calculated. Now I'm going to go to expenses. There are several types of most SaaS companies will have these expenses in their business. But again, if you're a bigger company, you might need to add more expense types in your plan, and that's easy to do. Just click here, add expense, give it a name, and then follow the process for providing inputs. So let's do that actually at the end. I'll show you how to do that. So first, paid marketing expense. The paid marketing expense, let's go into edit here. Go next. Now, the paid marketing expense will be calculated as, let me exit here for a bit, we'll come back. So paid marketing is usually calculated as the number of signups that we expect multiplied by what percent of those signups come through paid marketing channels, multiplied by the cost per sign up. How much does it cost our business to acquire one new customer? Yeah. So the number of signups we already have from our revenue stream. What percent of our signups come through paid channels? Let's say that 100% of our signups will come through paid channels, because we can't always define which one came from a paid channel and which one didn't. And then what is the customer acquisition cost for our business? Let's say it costs us $500 to acquire every new customer. Now, with those few assumptions, we have calculated the paid marketing cost for our business. Next, let's calculate affiliate fees. Now, not every SaaS business will use affiliates as a customer acquisition channel, but if you do, there are usually two types of affiliate fees. One is an affiliate fee that you pay one time per customer. Every time an affiliate brings you a new customer, you pay them a one-time fee, and that's it, a fixed one-time fee. And the second type is of affiliate fees is that you pay a percent of the lifetime revenue to the affiliate that you get, that from the revenue that you get from the customers that they brought to you. So those are the two types. It's a little bit complex here in Modeliks, but we made it in a way that is absolutely comprehensive for you to have a very detailed calculation about your affiliate costs. Now, to calculate the affiliate fees per new customer, we have the total new customer or signups already defined in our revenues. What percent of our customers come through these affiliate channels? Let's say that through this type of affiliate channel where we pay a one-time fee, about 5% of our customers come through this type of affiliate, and we pay the affiliate an affiliate fee per sign up of $200. Then affiliate fees as a percentage of cash collections. Again, what percent of all our cash collections or our revenues come through these type of affiliates where we pay a percent fee of the lifetime revenues that we generate from their clients? Let's say that we get 10% of our clients through these type of affiliates, so across time, and then we pay. And what is the percent of affiliate fees that we pay to these type of customers, to these type of affiliates? Let's say that 15% of the revenues that we generate we pay to the affiliates. And with that, we have calculated the affiliate fees for our business. I'm not going to go through all the way down through all the expenses. They're pretty self-explanatory as you go through them. I will finish with the sales expenses. Sales expenses in a SaaS business, usually the best way to define them is as a percentage of revenue. You have your own sales team that you have in house, your sales employees, but then on top of that, there will be There might be some bonuses that you need to pay to employees. There is other sales cost. So just define it as a percentage of revenues. Let's say that about 8% of revenues will go into sales expenses. Again, you can go more detailed on the sales expenses if you want. You can add an expense. Let's say, let's do that. Let's say that sales expenses as a percentage of revenue is one thing, but let's say that we want to have a cost for trade shows. Let's say, let's click add an expense. We plan to go to trade shows. What is the name? So trade show, trade shows expense function. What type? It's sales and marketing type of expense. And how are we going to enter this value for this expense? Is it a percentage of revenue, or is it going to be a dollar value? We'll leave it at a dollar value. We click next. And then we say, okay, in July we're going to go to one trade show, which is going to cost us $3,000. And then next year we're going to go to two trade shows, which is going to cost us by then $10,000. And then the year after that, again, $10,000 for trade shows. Click save and close. And now our trade shows expense has showed up there as we defined it. So go through each one of these expenses, add any expenses, additional expenses that you might have for your specific type of business, and in no time you will be done with calculating your expenses for business. Next section is assets. Now, usually in SaaS businesses, we don't have too many assets. We don't have machineries, equipment, buildings. So usually, what you would have is any office equipment that you might need for your employees to be able to work. So when we create assets here, we have created asset equipment as an asset in the template. You click on edit, and then this is office equipment type. It's a long-term asset. We expect to depreciate this asset over 3 years, and then we don't plan to we plan to pay the full price at the beginning when we buy this asset, and we don't plan to resell it in the future. So just simple office equipment for a SaaS business. We go next. Now we can either enter the amount of money that we plan to spend on computers, equipment, chairs, desks for our business, or the way I think it's probably the best way to estimate the amount of money that you will need for such equipment is to set a formula where the office equipment is calculated based on the number of new employees that you get over time. So instead of inputting the number of the value of assets that we will need to buy as office equipment, we'll click this button here, set formula, and I will set two. I will calculate the value of the assets based on two variables. I'll click here add driver or add variable. The first is going to be, I'm going to click select from existing. And this is going to be, I'm going to search here for the new employees. New employees, number of new employees. That's the one that I want. And the second variable is going to be office equipment, create new. Click here, create new. It's going to be equipment per new employee. I'm going to click create. Now, the asset or the office equipment is going to be equal to the number of new employees multiplied by the equipment per new employee. Click set formula. Now, the number of new employees that I get in each year or in each month are these. Then I'm just going to say it's going to cost us about $4,000. Let's say $3,000 per employee for desks, chairs, computers, any other equipment that they might need. So $3,000 per new employee. And with that, we have automatically calculated how much money we'll need to spend on office equipment in every period. Save and close. If in your business you have other equipment, specific equipment that you need to buy, then of course you click add asset. You name that additional asset that you need to buy. You define what is the lifetime value, or over how many years does it depreciate, and then you define when do you actually purchase this asset, and what is the price that you pay for that asset. Now we have defined our assets. Now what we can see is that actually we are running a negative cash balance, which means we need an investment, which leads us into financing section. Now, when it comes to financing, you can get financing from two main sources. One, you can get an investment from an investor. This is an equity investment into the company. And two, you can get a bank loan. Now, let's see. For in our case, let's say that we are able to get an investment of $100,000 for our business. So we're going to find here the equity investments line. We're going to go into edit, and we're going to say that at the beginning of the planning period, we're going to get $100,000 of any equity investment from an investor. Quick, click save and close. And I'm going to go back into assets. And what I'm going to see is that, again, we are running a negative cash balance starting from, well, from June. And sometime in 2024, we are starting to become profitable and starting to generate positive cash flow. So we'll need additional funding. Let's say that the rest of the money, about 115,000, let's say 150,000 dollars, we are going to get it as a bank loan. So we'll go back into financing. We can either add a new loan, or in the template there's a loan. We'll click edit. Now, the bank loan, there are a few inputs. When are you going to start? When are you going to get this loan? So we saw that we will need the loan sometime in June 2024. Okay, we're going to get it in June. We'll get 150,000, let's say, loan. The loan term, we're going to pay it back in, let's say, 36 months. And there will be an interest rate of 6%. There's no grace period, and we will pay back the loan monthly. With those few inputs, we will calculate all the cash flows specifically related to this loan. So now, if I go back into assets, I'm going to see that no more negative cash, which is okay. With these two, with the loan of 150,000 and an investment of 100,000 at the beginning, I can see that this business is going to become profitable and cash flow positive, and I will not need any additional cash investments. So that's it. We're done with financing. Let's go to taxes. Now, in taxes, most countries will have a income tax that the companies will pay on their profits that they generate. So it's very simple. Here in the template, we have the income tax. You click edit, and you just need to define what is the income tax rate in your country. Say it's 10%. Click save and close, and that's it. Your income tax has been calculated. If you want, in some countries there will be also a VAT, and there will be, or in the US you will have sales tax. If you want to add these taxes, again, you can just click add taxes, and there you select sales tax or VAT, whatever is relevant for your specific country. Finally, working capital. This is where we define what are the values going to be of the accounts receivable, or the money that customers will owe to us, how much inventory we will need to keep, and how much money we will owe to our vendors from which we purchase. Now, this is important for the cash flow statement, specifically to make sure that we don't run out of cash. Even because businesses, some businesses, even if they're profitable, they might be running out of cash because of the working capital. So just to make sure, in a SaaS company, usually that wouldn't happen. But just to be sure, let's fill out the working capital assumptions. So first of all, accounts receivable. There are two inputs here. One, what percent of the revenues that we generate do we actually generate them on an invoice that gets paid later in the future? Usually in a SaaS business, people pay ahead of time. You subscribe to a subscription plan, and you pay before you can actually use the software. So let's say that only maybe 10% of our revenues will be paid on invoice, and those clients, these are bigger clients, and those clients will have 30 days to pay the invoice. Inventory, as a SaaS business, we don't have inventory. Inventory is anything that any products that we hold in stock that in order to sell them, but because our products are digital, we have literally zero inventory. So this stays at zero. And accounts payable, from all the purchases that we do, and usually this is for the for any of the costs that we have, the IT infrastructure, any office expenses, any costs that are outside of employees. How what percent of them do we pay on credit terms or on invoice that we get to pay later on in the future. So let's say literally about 50% of our invoices we pay on credit terms, and we have 30 days to pay them. And that's it. With those inputs, we have finished the inputs for creating our financial plan. So let's see what is the outcome. Let's go to reports. First, let's look at the profit and loss statement. This is where we see what are all the revenues that we generated, all the costs, and what is the total net income at the end. So if here we're looking at an annual level, if you click monthly here, you can also look at the profit of all the financial statements for the first year on a monthly basis. So what we see is that we generate first year 800,000 almost revenue, the last year 3.3 million, or third year, and then we see that we become profitable in year three, and we create $478,000 of profit. Okay, if we're happy with this, that's good. If not, we would go back and see what assumptions we can change. Maybe in the revenues, maybe we can reduce costs somewhere, maybe we can increase revenues. It's an iterative process where you look at your outputs and see whether these outputs make sense. We can also see that our gross profit margin is about 86% in the last year, which makes sense for a SaaS business. Our EBITDA margin 15%. This should be improved, but we see that over time it keeps improving. So 15% is okay, but in a SaaS business you should be aiming to about 25 to 30% EBITDA margin. And that's it. Net income margin of 14%. So we see our profit and loss. It works fine. Let's look at our cash flow just to make sure we're not running out of cash at any point of time. This is our cash flow. This is how we generate cash, and this is the cash balance. It's always positive, so no issues there. I'm not going to look at that into more detail. And finally, for a SaaS business, because this is a SaaS business financial model template. In the report here, you have a SaaS dashboard, which includes all the KPIs for your financial plan that you would ever need in order to explain to first of all, to understand what are the most important assumptions and KPIs for your business, and also to be able to explain what are the most important KPIs to any potential investors. So here you have your bookings, or this is the total cash collections for all customers, bookings from new customers per month. You can look at it monthly, or you can look at it on annual level. This is the average contract value that you have for your business, the average contract duration in months. This is the average MRR, new customers and old customers, average MRR versus average ARR. Yes, average MRR versus new MRR, and average ARR versus new ARR. You have your average ARR for new customers and total customers, total MRR, total ARR. This is the total customers at the end of period. New customers, churned customers, and total net new customers. You have your customer churn rate, MRR churn rate, lifetime value of your customer and customer acquisition cost, and LTV to CAC ratio. Literally every KPI that you would ever need to understand whether your projections make sense and to be able to explain these KPIs to potential investors are already there for you, calculated automatically. And that's it. With that, I'm going to close this video. I hope this was helpful. It takes probably in about an hour, you're able to create a fully professional, investor-ready financial plan for your SaaS business in Modeliks if you start with the Modeliks SaaS financial model template. Have a great day, everyone. I hope you enjoyed this video and enjoy Modeliks.